half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with David Ingles.
Good morning. Our top stories today. Asian stocks extending this U.S. sell-off and worries about the industry that's powered the bull run. You might have heard ASML, the Dutch giant, of course, cutting its outlook. Stocks plummet. That's after booking only half the orders expected this quarter. Now, China's property sector will be in focus today with the housing ministry as the latest official department here to plan a briefing on measures to support economic growth. Plus, Donald Trump tells Bloomberg that tariff is his favorite word, defending his economic agenda and targeting of China 3 weeks out from Election Day.
Yep, tariff is Trump's favorite word, and that certainly did move the markets here overnight. You take a look at how the dollar is doing, and we're rising to that 2-month high. That's certainly, the vows to continue on and imposing tariffs after he wins, that certainly did roil the EMFX trade overnight. You add that with the ASML story, as Dave mentioned, they're cutting their guidance for 2025. And also NVIDIA seeing a pretty deep drop yesterday after that scoop from Bloomberg about the U.S. might be weighing exports to certain countries. That certainly doesn't bode well for Asia here today. We're already seeing the chip stocks falter in the region, and we're watching very closely how that dollar performs here right now. We're talking about 149 levels, still talking about 150 for near 150 for dollar yen, and we're watching oil markets as well after slipping some more than 4%. Now we're seeing a bit of a recovery here, but certainly there is some relief, at least from Israel, said it would make its own decision on how to attack Iran. But yes, that negativity, that bearish trend in oil prices seems to be kicking in once again. IEA also had a pretty downbeat monthly analysis when it comes to the demand picture as well. Taipei opening up. There you go. That's where you're seeing the downside. I'm guessing it's TSMC related. Let's flip the boards and show you what's really going on when it comes to that and the chip sector here in particular. So, yeah, the booking orders were not looking good. ASML, it's interesting enough that when everyone was getting a bit more, I guess, juiced up on NVIDIA and this whole renewed optimism around the stock, you're seeing a company like ASML cutting their guidance for next year. Where does the market get it wrong on this right now, right? That certainly is a key question. So there you go. Tokyo Electron, we're down about 10%. For that stock in particular. Some of the South Korean names also falling quite a bit, like SK Hynix down some 3%. Here's the approach to the open here right now. So obviously there's still that lingering question about what's next in this rally, or at least what we're seeing in China. HSCI had the worst day in a week on Tuesday on the back of that weaker data here. But yes, there's news of another press briefing, David, that's happening tomorrow. Is that going to be enough to, bring up the animal spirits again?
Yeah, well, let's hope it's closer to the PBOC's version than it was the NDRC in terms of just the potency and what the market's reacting to as well.
Well, the PBOC is making a comeback. They're coming back to this.
Yes, they're going to be part of this too.
Yeah.
And an unidentified official of the finance ministry, I think, is also taking place. Min will be joining us to give us a preview of that. Now, alongside that, so of course, we're looking at a varied number of sectors today. So we have property for obvious reasons, Tianjin, and some news out of Tianjin. We'll get more on that in a moment. So that's number one. Number two is property in Hong Kong, because you have this briefing, of course, the policy address coming out of John Lee in about 2 hours from now. There's a 50-year bond auction today. We'll see what demand looks like there. We're starting to see initial trickling through of some of the prelim guidance coming through. Insurers came out big. Keep in mind, right? A market rally means that insurers are probably sitting on a lot more P&L, better P&L than they would have been otherwise. Chip stocks, you have luxury stocks as well on the back of what LVMH had to say as well. And yeah, I mean, we'll see what happens going into this. So a lot of sectors to watch, and obviously the drag we're getting from the chip sector because of just how heavily weighted those stocks are in those specific and respective markets will be one to watch as we look at some of the index trades today.
Yep, and we're looking ahead to Thursday now with China's housing minister, as we mentioned, will hold that briefing tomorrow that could provide more details of measures to support the slumping property sector and bolster economic growth. Let's bring in our China correspondent, Min Lo, for more on what can they bring this time around.
Yeah, so it's a joint briefing with the Ministry of Housing, PBOC, Ministry of Finance, and the National Financial Regulatory Administration. So we are hoping that they will give us more details in terms of implementation of the Politburo's intention to stop this decline in the housing sector, right? Because the Ministry of Finance on Saturday did say that local governments can now use funds from special local government bonds to buy back idle land as well as unsold homes, but they didn't give us the scale of how much bonds can be issued as well as their target in terms of how much of these unsold homes that they want to clear out of the existing inventory and a timeline for that as well. So these details are what we're looking out for. And also there hasn't been any indication so far as to how the government will tackle all these homes that are sold, 48 million of them, but not yet finished. And according to Bloomberg Intelligence, it's going to take another 11 trillion yuan of support to finish these uncompleted homes. And this is key because it's a major barrier. If people are not confident that the houses that they buy are going to be completed, they're going to shy away from the housing sector. So we're looking out for measures on that front as well.
Min, thank you so much. Min Lo, China correspondent. And as we try and figure out really what gets consumer spending, markets are also trying to figure out the same thing. So this initial leg higher, the easy money's been made, right? So this initial 35, 50% up, depending on which index you look at. The drop from the top for the benchmarks were down from the last week or so, let's say 10 to 18%. Although after that, we're still up some 20% from the bottom on September 23. Does this bull market have legs to run? Let's bring in George Sun, Deputy China CEO and Head of Global Markets for Greater China at BNP Paribas. We were just talking about this right before the show started.
Yes.
This massive swings we're seeing in the equity market. How has this changed your world, George Sun?
Well, thanks for having me on, David and Yvonne. It's been very active for our trading desk since September 24th. The announcements were made before Golden Week. We think actually it's just the first leg that's happened. We think that actually once the September 24th joint announcement by PBOC, CSRC, NFRA, they were very well coordinated at press briefing. And then 2 days later, President Xi himself at the Politburo reinforced the message. So we really think now all these press briefings that you're seeing now, it's just all the different ministries showing they're doing something now, right? Whether they have something really meaningful to say with specific numbers or not, just the frequency of these show that they mean business. We think that the first leg was really retail money, fast money, retail money that came in. That's why during Golden Week, all the Chinese brokers, they didn't take off that week. They were opening accounts. Yeah, they were opening client accounts, right? So the first set of money was all that idle money that was sitting around, kind of pent-up demand over the last 2 or 3 years. So money went in. Money went into the markets. It went up 35 or 50% depending on the index. So it's now the first wave is taking profits. It's pulled back actually now, right? So some profits have been taken. It's still substantially up, but we've reached this kind of a local equilibrium for the time being. But what we haven't seen is the big institutional money come in yet, actually, both domestic and international. What we hear a lot from clients are, big institutional investors, we missed that first wave. It happened so quickly, we missed it. So now they're deciding, okay, how much do they redeploy into the China equity markets now or the Hong Kong equity markets? Because if they don't, and this continues, they're going to underperform their benchmarks for the year now. So what we see now is we're seeing some selling from the institutional side on the long end bonds, actually. So selling some long-end bonds, especially if there's rumors that the MOF is going to issue 6 trillion of long-dated special government bonds over the next 3 years. You're going to see the long-end yields go up in China. You're going to see a bit of a bull steepening, so it's a good time to sell your long-end bonds, position yourself for the equity market.
So they're getting ready, as you say, George. What's going to trigger that second leg then?
I think we're going to wait for the National People's Congress, actually, which will be end of this month or beginning of next month. So end of October or beginning of November. I think at that Congress, at the National People's Congress, they'll come out with more substantial numbers to all these stimulus measures that we're talking about. It'll be ratified by the Congress, and then it's rolled out, I think. So at that point, you'll probably see another leg up with the institutional money coming in at that point.
What we haven't seen so far are direct measures to address new stimulus for the consumer. Minimum is pointing out, of course, it's the housing market. When they fix the housing market, most problems will tend to go away. Do we just wait for that? Is that about to happen?
Yeah, we were discussing that a little bit this morning, right? It's this whole transmission mechanism that's really important. Just because they've decided they're going to print, let's say, $6 trillion of special government bonds, how does that money get to the consumers and businesses and open up their wallets to either spend more or invest more in the stock market? Because we were looking really since COVID ended at the end of 2022, the last 2 years, consumer confidence has stayed pretty low. It's nowhere near where it was in 2019, actually. And the savings rate is very high. It's like 42, 43%, which is way too high for a big country. So people are not spending the money. How do you open up this money? I think this kind of central government issuance of bonds that then goes to the local governments, there is a mechanism there because the local governments are really short on money right now. In fact, to the point they're not paying on time even government officials, suppliers, construction companies, etc. Salaries. So people are not getting paid on time. So if this government, special government bonds get issued, money goes to the localities, the municipalities and provinces, and then they pay their suppliers, construction companies, officials. Then the spending, people have money again, they start spending, and that's the mechanism. I think this this will have a higher multiplier actually in the short term to get the economy back on track. That's where the actual spending will occur.
Okay. Tell us what the strategy is. What are you telling clients if they're selling bonds and getting ready for the second leg? What is the second leg going to look like? What's going to drive it?
Well, we think actually the second leg will be when the announcements occur. We think actually the institutional investors who have rotated out of China the last couple of years, they're going to at least increase their allocations a bit to China. So I think the indices will go up. Certainly the tech sector, that seems to be the very undervalued.
Onshore or offshore, you think?
I think both, actually.
Okay.
Onshore and also the HSCEI, for example, offshore. So I think both will take a leg up, actually. And probably this will end up being higher than the peak that we just achieved. So we went up 35, came back 12. Right. The second wave will probably end up being more than what we were 2 weeks ago.
So these valuations, while they're closer to the historical mean, they're still cheap in your view?
They're still cheap. I think they're still cheap, actually, especially compared to the rest of the world where everything's so expensive, actually. Everything's really priced still to perfection in the U.S., right. Actually, for example.
No, I guess while we wait for things to show up in whether that's economic data, while we wait for corporate earnings to bottom out, where does, we're in this sort of, I don't know what term to use, this almost purgatory period between the initial leg and the second leg. Where does one maintain exposure?
I think right now some of them are still in the bond markets, actually, because the relative yield is still okay. But I think once you see the rotation occur, you've got to get out and get into the equity market.
All right, George, we'll have more from George Sun there, Deputy CEO of China and Head of Global Markets for Greater China at BNP Paribas. Still ahead on the China Show, we'll be joined by Alibaba's International's Vice President Kaifu Zhang for exclusive conversation about their AI strategy. We're also counting down to the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show.
We're all about growth. We're going to bring companies back to our country. To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm. I had a very good relationship with President Xi, and a very good relationship with Putin, and a very good relationship with Kim Jong-un.
You worry about that?
The dollar is so secure. Your reserve currency is the strongest it'll ever be. I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all. Take a look at Detroit. Take a look at our cities. We're a developing nation. We have to develop more than they do. We're way behind them. You take a look at what's happened to our cities.
Republican presidential nominee and the former President Donald Trump there speaking to our editor-in-chief, John Micklethwait, about his economic agenda 3 weeks out from Election Day and calling tariffs his favorite word. Still with us is George Sun, Deputy China CEO and Head of Global Markets for Greater China at BNP Paribas. How are you looking at this market leading so close to this election and year-end? Is it going to be driven a lot by the U.S. election risk, or do you think it's still going to be about the Fed?
I think it's related, actually.
Yeah.
I think it's related because what happens in the election may impact what the Fed is able to do next year. So, and to be honest, I think even the Chinese are a little bit waiting to see what happens in the election before the full plans are rolled out of the stimulus, because just in case there is a second Trump presidency, they may need more ammunition to be able to boost up the economy if the tariffs go to 60%, as Trump has said his favorite word is. Yes. We think, one thing we do think, though, that the global markets have they're underestimating the possibility of Trump winning the election. What's interesting, we had a political economic analyst come through Asia. We've met with a lot of clients. We think Harris is still slightly ahead of Trump, including in the 7 battleground states. But the fact that she spent 3 times as much money as him in these 7 states, and she's only ahead maybe by 1 percentage point within the margin of error, that's a bit nervous, I think, for the Democrats. So we think there's 4 scenarios. If you look at the presidency and Congress.
Yeah.
Okay. We think the most likely scenario is Harris wins, but Republicans retain the Congress. So you get a split government, 35% chance probability of that. But the second most likely, 30% probability, we think there's going to be a Republican sweep. Trump plus they win the Congress, House, and Senate. 20% chance that Trump wins the presidency, but Democrats win the Congress, and then only 15% chance of a Democratic sweep. And the thing that we're most confident about is actually Republicans retake the Senate. And it's just simple numbers. Right now, the Senate is 51 Democrats and 49 Republicans. But the way the Senate works is 100 senators. They have 6-year terms. So every 2 years, 1/3 of the Senate is up for re-election. Yeah. This year, the closest 7 seats are all held by Democrats right now. So they would literally have to win every one of those seats to be able to retain.
Has to go perfectly well.
It's going to be tough, I think. It's going to be tough. So it could be, and you know, if it ends up being gridlock, let's say Harris wins but a Republican in Congress, it'll be kind of like the similar policies that we have now, a little bit of gridlock, similar to the Biden administration. But if you get a Republican sweep, what you're going to see is lower taxes. So Trump has talked about slightly lowering personal and corporate taxes, but the tariffs are the main thing. The tariffs, if you go 60% or anything close to that on China, and then 10% on all other countries in the world selling things into the U.S., what we think will happen, that will be inflationary. Because one, lowering the taxes will increase the government debt, and secondly, these tariffs will lead to supply chain costs running up. So what you will see is inflation picking up in the U.S. next year if Trump wins. And if that happens, yes, the Fed will probably lower another 25 to 50 basis points in November, December of this year. But originally, we had anticipated they would lower another 100 basis points next year to get to a terminal rate of 3 to 3.25%. But if inflation starts heating up early next year, if Trump gets elected, and you have these inflationary policies, the Fed may not be able to move much lower. And in fact, they may even have to raise rates sometime late next year. That would be a reversal. So then the terminal rate doesn't get to 3. Maybe it's at 4, 4.25.
Well, I mean, we're at 4 on the 10-year already. And you know, most of the, if not all the scenarios you put out, it just, you know, back of the envelope calculations seem to suggest that there's more than 50% probability that yields are probably too low. At this point in time, is that a good assumption? Is the dollar still weaker at these levels, given those scenarios that you just laid out there?
Yeah, I think Trump would like the dollar to weaken. Actually, in his scenario, he would like, for trade purposes, he likes a slightly weaker dollar and protectionist policies. Actually, so you could see that happening. The Fed trying to lower the rates as much as they can, and then the dollar weakening as a result. But then, if inflation heats up, they're going to have to actually possibly maintain or even raise rates at some point. And that will strengthen the dollar again, actually. So that's the tension that you're going to see, actually, there. So it's quite interesting. And I think under both Trump or a Harris administration, we see them both spending more. So actually, the deficit's going to increase under both of them. But under one of them, Trump, you're going to have the additional trade barriers, actually, which will be more inflationary than if Harris were to win.
How do I express that across China market? If Trump actually does win, I mean, where am I going to see that first?
I think you'll see the FX right away, actually. I think the dollar renminbi will shoot up, actually, because people will worry that the renminbi will be heavily impacted by the trade policies, actually. And so that will have a negative impact right away. But over time, I think China learned from the first set of trade wars that started in 2018. So over time, things will adjust. But I think initially that's where you'll see it mostly on the FX side, actually.
So for long-only investors, just to wrap things up with the China part of the conversation, right? A lot of them are sitting on gains because they got in early on the AI trade, right? If that bull market hits a wall, because the Fed's not able to cut, does that money then come to China, or does China become almost collateral damage to a U.S. equity market that doesn't continue?
I think it'll be the whole markets actually sell off in that case. Actually, I don't think it necessarily comes a lot to China either in that case.
Okay, well, on that positive note, George, it's nice to see you. Let's talk again. So George Sun there, Deputy CEO of China and Head of Global Markets for Greater China at BNP Paribas here. Right, coming off a 3-4% drop that we had on... It's Wednesday. On Tuesday, we're going into the Hong Kong Open today, and it's a big day here in Hong Kong.
Yes, so we're about to hear from John Lee, Paul Chan, the like here, talking a little bit more about this policy address that's happening in about 90 minutes or so. So everything from the property sector, are we going to see any sort of measures to boost this real estate market? Everything from a liquor tax, the like, to revive the nightlife as well. We're looking for all these different sorts of clues in the next few hours or so. Hang Seng, though, as you say, pre-market, we are down another 0.9%. CGBs, rallying some 1 basis points lower for your Chinese 10-year yield, and 7.13 for the currency. Plenty more ahead. This is Bloomberg.
All right, we're going into the open today. Some weakness coming through. So there's the China story. There's an event risk on the table as far as Hong Kong goes with the policy address. And then there's also the drag we're getting from a lot of the big and mega cap stocks across the region, TSMC in Taiwan. You have a lot, of course, in Japan and Korea. This massive pullback across the semiconductor plays really making itself felt across these prices right now.
Yeah, in terms of analyst actions, we're watching China Tourism Group, a move there from Goldman Sachs cut to neutral for those shares with a price target of $66. HSBC also cutting some of these airlines in China, Air China, the like, they're cut to reduce. And Sasa International also cut to a hold at DBS Bank as well. Certainly some stocks to watch is the luxury sector. So LVMH, we saw double-digit losses yesterday in the stock on the back of what they talked about, cooling demand in Asia, in particular when it comes to China sales. So that seems to be rocking some of these luxury stocks, not just in Hong Kong, but across the region, Shiseido, the like, here today. But there you go. You are seeing CGG duty-free, China Tourism Group down some 3.5%, Prada's down some 3% as well. We're still watching these chip stocks, although the ones that are listed in Hong Kong, of course, are the China domestic plays, which, yes, they kind of have their own sort of supply chains, but then again, also feeling the effects of that drop in NVIDIA, ASML overnight as well. SMIC down some 4%.
Yeah, we'll continue to unpack, of course, the chip story coming out. It really goes to show, and it's a big story when the maker of the machines that make the chips is flagging some of that they're not able to meet their orders coming through, right? So we'll see what happens with this as we move in. And by the way, coming up on the shows, we'll have a conversation out of Taipei and really what that market looks like, this bull market, and a deeper dive into Taiwan in a moment here. Going into the open today, we're looking at a 3-day decline so far in the Hang Seng Index. We did get a pullback of about 2.5% in the onshore market. There's a 50-year bond auction today, in case you missed that. We're also looking at things like all things property, housing market, banks, all that and more. The open just ahead.
Welcome back. You're watching the China Show. We're counting on to the open of markets. And yes, as we continue to watch these markets, it looks like this consolidation continues, not just in Hong Kong, but we're talking about the CSI 300. Basically, we're close to 10% losses here from the highs that we saw in the early part of this month, Dave. Yeah,
at least, well, it was nothing was going to go up in a straight line, right? 40% up, at least to the point of our guests recently, that it seems that the market is stabilizing at higher lows. We'll see what turnover looks like. Of course, a lot will depend on these briefings taking place. And, in case you missed it, this time tomorrow, there's another one. You have the Housing Ministry. It's a joint briefing. You have officials from the PBOC and the Ministry of Finance also joining in. It will be talking about measures directed specifically to the housing market. What they will say, we'll just have to really wait and see. Speaking of briefings, as you look at the benchmarks right now, it's also worth pointing out that here in Hong Kong, the policy address, and within that, of course, we're looking at things like the property sector, will be very much in focus as well. The big stocks, bottom of your screens, of course, on the CSI 300, which is down 1.3%. In terms of moving averages, right, so we've moved away really. It's gone up so quickly that a lot of the daily moving averages are not indicative really of short-term moves. So we're looking at weekly moving averages at this point in time. We're down 2.5% on the CSI. We're down a further 1.1% as we speak. Speaking of insurers, I'll get you more in a moment here because we are getting some prelim numbers coming through from some of the big insurers. So I think long story short is good set of numbers, good set of guidance. The rally certainly helped because a lot of them are sitting on equity holdings, of course. Flip the boards, please, and have a look at where we are as far as Hong Kong goes. 3-4% drop that we had on Tuesday. We're looking at a further 0.5% as we speak. So give or take from the top, we're down about 10 to 15%. From the bottom on September 23, we're still up some 20%. Alibaba conversation later on, of course, with the company taking place. Very quickly, change the boards, please. So you look at property developers. We talked about the guidance and the numbers coming out of LVMH. Some of the big luxury plays are seeing some downside right now. As we pointed out, a lot of the insurers are moving against this sort of downdraft today because of the prelim numbers that they've released so far as well. Our guys at BI have actually pointed out that profits for this specific group might actually double amid the equity rally. Speaking of the equity rally, one group that's really done very, very well, we're seeing a pullback today because of the ASML story, are the chips. When the chips fall, SMIC getting underway. Tokyo Electron has been up and running for about 90 minutes now, Yvonne. So we are seeing some declines at TSMC, of course, down about 2.4% over in Taipei.
Yeah, and a lot of it might have to do with some of the risks that what we're seeing here in this Trump interview that we did that talked a little bit more about tariffs, right? That
Right.
Donald Trump doubling down in some ways about his pledges to impose tariffs if in fact he does if he wins the presidency, I should say. But more with that interview with Trump, who's defending his economic agenda against big business fears over inflation. Trump told our Bloomberg editor-in-chief, John Micklethwait, that his economic policies would stimulate growth despite adding to debt.
I had 4 years no inflation. But
that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Deal. It was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong about
You're trying to turn this. You're trying to turn this.
You've been wrong about
No, you're trying to turn this into debate. There are business people. There are business people.
You've been wrong. You've been wrong all your life on this stuff. You've been wrong. Let me tell you about currency. You're go and jump in a lot of different subjects.
Well, you're sticking to the subject very closely.
Let's stick to reserve currency. That's where you start, right? The reserve currency is under threat because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it.
Yeah.
They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership, they look at this guy, they say, you got to be kidding, and she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe it. This is not what, we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world status, lose your reserve currency. We have to have that. We cannot lose it. if you you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency, we're not going to salute the dollar anymore, I'll say, that's okay. And you're going to pay a 100% tariff on everything you sell into the United States. And we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers.
And that was Donald Trump speaking with Bloomberg's editor-in-chief, John Micklethwait, just there. And really one of the other things that he did mention, of course, was the word tariffs. And certainly going into the election 3 weeks away, the threat of such looming over parts of the equity market, of course. When we're looking at Taiwan, this big drop you're seeing today really down to the fact that we are seeing, of course, this pullback across global chip shares on the back of the warnings and the numbers coming out of Dutch chip equipment making giant ASML. Let's bring in our Bloomberg editor-in-chief emeritus, Matt Winkler. He's in Taiwan. Matt, it's nice to see you. Your column today underscores Taiwan as a bastion of prosperity. You talk about the stock market, this bull market that's outperforming most benchmarks in the world. The currency that's seen volatility almost, I would say, even near zero. It's very, very stable. And, of course, bond yields, which are among the lowest in the world. Matt, help us underscore the thesis here that Taiwan really punches above its weight.
Well, as you say, it's not just one of the best stock markets. It's the best, because we can calculate that on the Bloomberg terminal. It's the best performing stock market in the world. And that has behind it, of course, booming real estate, record exports, unprecedented real earnings in Taiwan. That's because wages have been going up. And everywhere you look, this is an island that is, in fact, an oasis of almost doing everything right at this point in the world. And as you note, the prevailing narrative is that Taiwan is either suffering from some man-made disaster, which is the geopolitical discussion that never ends, and then there's the man-made disaster like the latest typhoon. The fact is, though, that in spite of these things, Taiwan over the past 5 years has relentlessly become more prosperous. And of course, it has everything to do with one of their biggest exports, which is semiconductors, which are the brains for just about everything we use today in the world that comes from, if you like, between our ears. So whether it's smartphones, whether it's cloud computing transition, whether it's electric vehicles, or more importantly, U.S. national security, which is a priority, it all comes back to Taiwan. And Taiwan is tethered to the largest economy in the world, the U.S., in a way that no economy is. And that's why you have this dichotomy between what people talk about every day, which is, again, the geopolitical discussion, and the reality, which is things just keep getting better here.
Matt, it's interesting, right? We've talked about this whole silicon shield that Taiwan has with a company like TSMC, right? Retail investors can't seem to stop loving this stock in some ways. But then again, you talk about the geopolitical risks as well. You have the likes of Warren Buffett that sold his holdings of TSMC on the very fact of this threat from China. You have also at a time when investors are questioning this whole AI frenzy with a lot of caution here right now. So how resilient do you think Taiwan can be in the face of those risks?
Well, the reality is that the demand for computer chips doesn't go away. In fact, if anything, it only increases given our appetite for innovation. And the innovation is entirely dependent on chips. So even though we will continue talking about all the risks and threats that you're mentioning here, the real story is that the economy in the U.S. and the economy here are inextricably linked together, and to the extent that both are growing, the appetite for what comes out of Taiwan doesn't abate anytime soon.
Yeah, Matt, to your point, I'm wondering, Taiwan sits at the very top of the semiconductor industry and effectively sits at the very top of really our way of life. And, global investors, can't, when you look at how the market's done, for example, I mean, the component as far as global portfolios goes speaks for itself. The fact that Taiwan keeps coming up in the strategic rivalry between China and the U.S., I think even underscores that importance even more. Matt, how do you think global investors should be looking at this as a risk or opportunity?
Well, the one word that invariably motivates investors worldwide is growth. Nothing gets investors more excited than growth, rising sales. And the fact is that sales of not just chips, but all the products that are related to chips are going to keep growing because the global economy is going to continue to grow. So, look, we've had atomic weapons since the end of the Second World War, and fortunately, we have avoided using them. So the geopolitical risks are never going to go away, obviously. But in the meantime, the global economy is going to keep innovating and progressing, and Taiwan is right in the center of it. And that's the point, is that it's just as important as any part of the U.S. And you could say, Taiwan and California have a great deal in common with each other. They're siblings.
Matt, it's great to have you in the region. Enjoy the rest of your trip. Matt Winkler there, our Bloomberg editor-in-chief emeritus, joining us out of our Taipei bureau. Coming up next, we're going to talk AI strategy with Alibaba International's Vice President Kaifu Zhang. This is Bloomberg.
All right, look at some of the chip plays across this Hong Kong market. Nothing much to tell you about, if I'm being completely honest here. So why don't we just get the conversation on, rolling on?
Well, we're still talking about this whole AI sort of outlook, right? When all was, we were promised, we were talking about AI and this whole spending frenzy that we're seeing across these companies, and that there's nothing that can really derail this trade. And then all of a sudden you hear ASML talk about, chip sector weakness. They're not even getting the bookings that they're projecting. What does that tell you, right? What are we missing in this whole picture here about how strong this whole AI demand picture is really going to be? You look at it in the China lens. Our team at Bloomberg Intelligence is saying that Chinese tech firms do face an uphill climb in monetizing AI products due to intense competition. Now, Robert Lee and his team say prospects may improve with industry consolidation, though the probability of that happening is low.
Yeah, you know what? It's interesting, right? So we were just having this conversation earlier on with our chairman, editor-in-chief emeritus there, Matt Winkler in Taiwan, right? So one of the books that I always recommend people to read is Chip War. I think it's one of the best books on the subject. And timing-wise, short term, right? We were just talking this week about NVIDIA reaching its record high. We're going into earnings season, and what expectations should we have for a company? And Qualcomm, for example, is another one too. Should we have for a company like NVIDIA that's a bellwether for the industry, when in fact you could make the same argument that a company like ASML probably has a better pulse of the market, a more broader pulse of the market, because it makes those equipment that makes the, that goes into everything else, right? It, if I'm not mistaken, at least has a 90% market share of its own part of the ecosystem. And then the China conversation is a company like SMIC, for example, which the reason I bring Taiwan up is a company that is the vision, at least, was to become the hedge against the TSMC, which is a fab, for example. But anyway, we're getting into the weeds of things as well. But yes, absolutely. You know, the AI conversation around Chinese software and makers is the next fuel in the fire. And I guess, what do we do with, you know, these big names like Alibaba and Tencent? What do they do with it, with that software and that capability as we speak?
All of which are investing heavily into the sector here right now. Let's get to our tech reporter, Annabelle Jewelers. She has more from Sydney with our next guest. Belle.
Thanks, Yvonne and David. Yeah, to your point, I mean, that's sort of one of the key questions that's facing a lot of Chinese tech companies. That heavy spending we see into AI, it hasn't really paid off just yet. And of course, something we see for a lot of other big tech companies in the US as well. But you mentioned Alibaba in particular, and they actually have a new tool that they're releasing to the market for their international arm. This is AIDC. To set the stage, AIDC, it looks after a number of e-commerce companies, so Alibaba.com, Lazada, Trendyol that operates in Turkey, but they are bringing out this new tool to the market. So let's get more now, bring in Kaifu Zhang. He is Vice President of Alibaba International, joining us exclusively this morning. And Kaifu, I don't think your title really does you justice for what you actually are doing for AIDC, but you're essentially implementing AI across the business line. So talk us through this new tool that you're bringing out, and why now?
Yeah, thanks, Annabelle. So, I mean, I've been listening into the conversation just now, and it seems like a really good day to talk about AI application and monetization, right? And there's all this conversation on NVIDIA, on the chips, and on whether people are sort of recuperating all their investment into the chips. And we are very application-oriented. So, as you said just now, we're in the business of global commerce. Basically, our mandate is to help small and medium-sized enterprises around the world to sell online, right? and to sell to many foreign markets, right, for those merchants around the world. And we have this AI stack, which really help them to polish or to automate a lot of the processes in their e-commerce journey, like marketing, product listing, translation, customer service, design, compliance, etc. And we've been having the system for about a year, and now we have about 500,000 merchants adoptions, and actually more than 100 million API calls a day. So basically, we are seeing real value from AI. Right? We're seeing real value from our investment into AI, and we see that it's actually helping the small, especially the micro merchants, disproportionately. Right? And we are actually pretty happy with the value, especially for our customers, we can create with AI. And the announcement that you mentioned just now was actually a component of our AI stack. That is the translation part. Translation is really the bread and butter of a global e-commerce operation, because you have to translate your product listing into different languages if you want to build a global operation. And we just updated our translation infrastructure with large language model. Right. So previously it was based on the original generation or the previous generation of NLP machine learning algorithms, but now we have completely revamped it based on large language model, and we're happy to report that we're actually achieving overperformance on most of the language pairs across a number of public benchmarks compared to some of the alternative solutions in the market, including Google and some of the other leading solutions. Yeah, so that's the update. Yeah, please, Annabelle.
Kaifu, I want to understand more about the sort of competitiveness and how you think that AI, and you actually, as to your point, how you're actually deriving value from it. Because in the landscape that you're in, you're competing against the likes of Shein or Temu, for instance, in international markets, TikTok Shop. Yeah. How would you say that the AI offering that you have compares to these? And again, how do you actually see the value and how much is being derived?
Yeah, so maybe the starting point is really to look at why it's really to take a step back from AI and to look at global commerce in general, right? So basically, what we're talking about here is really small and micro-sized enterprises and merchants from a lot of developing countries, right? So a lot of our merchants come from China, many of them come from Southeast Asia, Some of them are from Turkey. And when they're trying to sell to Europe or to the Middle East, they actually face a lot of problems or challenges in terms of language barrier, in terms of understanding of the local market, in terms of having the right access to talent, and whether you can produce good enough marketing messages. And all of this translate ultimately into the conversion rate for those merchants and into the bottom line, right? So if you don't have a good enough product listing, there's language problems, there are like various issues, you cannot convert. I mean, it hurts your sales. So what AI is doing is to help them generate better product listings, to get better marketing messages, and to get better customer service, better quality of customer services, and that translates also into the competitiveness of our platform, with respect to the others. So, but at the end of the day, what we're seeing here is that AI has a lot of potential to make global communication in general much easier, and to make global e-commerce much smoother in particular. And this leads to a win-win situation for everybody. And the translation tool we are sort of announcing recently is actually exactly to that point. By applying large language model, we get better translation quality, and actually, especially for some of the less represented languages, right? Some of the minor languages spoken by fewer people. So that's where the traditional or the conventional NLP translation tools sort of fail to deliver. But yeah. Yes,
Can you share more details exactly on how much revenue you're deriving from this? Because I know that you have pricing models already for some of the AI tools.
Yeah.
How much money are you actually making here?
Yeah. So we offer most of the tools for free to our merchants, right? So that's the starting point. And why is that? Because our main business model is really is really driven by commission and advertising. So when our merchants make more money, I mean, we get higher revenue from it. Okay, so that's really the starting point. So I don't think I can share with you the exact number here, but I can give you some color into that. So a lot of our tools are able to improve the quality of content online to such extent that we get sometimes a single digit and sometimes actually a double digit in terms of conversion rate enhancement, right? The idea is that if you look at a piece of content that is not produced by AI, it's produced by some of the micro-sized like merchants on their own, and you compare that with a piece of content that is produced by AI, the conversion rate can be higher, sometimes 10% and sometimes 20, 30%. Okay, and you can do a back of envelope calculation, and we're using AI across about 40 different scenarios. So if you put everything together, you can sort of do a back of envelope calculation. It's actually a significant improvement in terms of GMV, because conversion rate translates into GMV, and GMV translates to ultimately into our revenue. Okay, so I hope that can give you some color on the link between AI application and the ultimate bottom line impact.
All right, Kaifu, unfortunately, that's all we've got time for today, but that was Kaifu Zhang, their Vice President of Alibaba International, as the company and its international arm, AIDC, releases another AI tool to the market, Dave.
Okay, yeah, Bill, that's something, sounds like we can continue the conversation next time. Bill there, of course, with Alibaba. Plenty more happening in these markets. We'll wrap up, of course, these big moves just ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI half hour into the session, and we're continuing to see weakness when it comes to Hong Kong markets here. But then again, I spoke too soon. Everything is kind of moving in the better direction here right now. It's just been a roller coaster basically since September. If you take a look at how things are going, volumes are still quite high. So at least we're turning slightly to the positive side. But certainly investors are, in some ways, you could say, losing patience here on really what this rollout of stimulus measures are going to be. We're looking ahead to tomorrow at that another briefing here and bringing back some of the people that came through in the other briefings as well, Dave.
Yeah.
So how many more briefings?
Our guest in the last hour, George Sun, said, because President Xi showed up, of course, at the Politburo meeting, a lot of the different economic departments are now looking to come out with briefings just to show, at least for one, that they're doing something. Second is, of course, how they plan to execute that plan. And to your point, right, so they're taking tomorrow's briefing will include some of the best practices from the September 23rd, which is the PBOC and officials.
Pan Gong-shen's going to be there, yeah.
Pan Gong-shen's going to be there. Some officials from the Ministry of Finance, I think, which I'm stealing Min Min's thunder. She's sitting beside me and giving me a bad look. So we'll get to more on that in a moment. But to that point, right, markets are responding to this. So like HSI is moving up. You look at some of the property names, which we'll show you in a moment, also moving up as well. Asia ex-China, though, is getting pulled down from another story, which is a chip story. So we're down 0.5% there. And it really goes to show, right? So what happens with the chip story? Does that mean money is going to come to the Chinese market because of the ASML story? At the moment, we're looking at a flat session on U.S. futures. Nikkei, Kospi, TAIEX markets are heavily exposed to the AI story, are seeing quite a substantial pullback. Very quickly, chips across your board are down. It's going to come up on your screens very, very shortly. TSMC, SK Hynix, Samsung, Tokyo Electron. Take your chip maker, pick your chip maker. Insurers are also coming out, and this is an opposite story because of the market rally. Chinese insurers are seeing some upside here, some prelim guidance coming through, as you can see, moving against the grain. And as we promised you, property names jumped as much as, I think, 8%?
7-8% at one point. I mean, this is in anticipation of that press briefing tomorrow. So we've heard from the MOF, heard from the PBOC, NDRC. The housing ministry is probably going to be the one that's driving this press briefing tomorrow. And maybe we'll see. We're hoping that we're going to hear a little bit more on ways to support this real estate sector. So that's happening Thursday this time, tomorrow.
Yeah.
So, you know, we're on tenterhooks of what could actually come through here. Let's bring in Min Min Lo, our China correspondent, on what people are saying, right? What is still needed this time around?
Yeah, well, this morning we had news from Chinese state media that cities like Tianjin, for example, are already starting to implement some of the guidelines that the PBOC had laid out, such as removing any down payment ratio differentiation between first and second home purchases and reducing existing home mortgages, mortgage rates as well. But these are, you know, measures that were announced by PBOC, and we're seeing that implemented right now. For Thursday, I guess what markets are really hoping for is details of how this directive from the Politburo to stop the decline in the property sector, how is that going to be implemented? Because we heard from the Ministry of Finance on Saturday that they're going to allow the widening of the use of special local government bonds to buy back idle land and unsold houses. But there wasn't a sense of scale, how much bond issuance would that be, and also timeline and targets, how much unsold homes do they plan to buy back. So these are the details that we're hoping to get, whether there will be measures to target or to support those homes that are already sold but not yet completed. There are about 48 million of those on the market. And we had George Sun just now from BNP Paribas saying that maybe we won't hear anything new because maybe it's just the ministries showing their bosses that they're doing something here. And the big news will still have to come from the legislature meeting that's going to take place late October or early November.
Yeah, but markets are, to your point, right? They're listening to these official briefings. They're also looking at what's been taking place in media. And to be honest, I've been a bit confused this week on you know,
debt swap.
The debt swap, right? Who is issuing the bonds? How much are issuing? Is it local governments? Is it central governments? Is it a debt swap? Is it debt forgiveness?
Okay.
What are you hearing? What's the latest here?
Okay, so this is a little bit confusing because Caixin yesterday reported that the government was mulling 6 trillion yuan in ultra-long special sovereign bonds issuance. But what Bloomberg is hearing is that it's 6 trillion yuan in local government special bonds. So the difference here is that if local governments are the ones issuing these bonds, then that means that the debt burden will be taken on by local governments instead of central government. So central government is not going to take on additional debt burden. That's going to disappoint some economists who have been calling for the central government to take on more borrowing and spending responsibility on behalf of the economy. Because right now, if you look at the total national debt of China, majority of the debt is taken on by local governments and their financing vehicles. Central government only holds about 25% of GDP worth of debt. So that's key. If local governments are the one funding this debt swap and taking on the hidden debt onto their own balance sheets, that still gives them some relief because then they will have a longer duration to pay back their loans, their debt, and a lower annual interest rate. So it does still free up some of their financial resources to actually spend on the economy, to pay back all the people, the contractors, the civil servants that they owe money to. And we're already seeing the local government financial vehicle bonds, the AAA rated bonds, those have been rallying on the back of this news.
That's right, yeah. So I guess the hope is they're both wrong, but combined they're correct. That we'll get
12 trillion yuan.
One plus one, and not one or the other. If it's confusing to you guys, it's confusing to us. Min Lo, thank you so much for giving as much clarity as possible there. CGB market 2, 5, 10, and 30. We have a 50-year bond auction today. Just keep that in mind. Maybe we have another person. Maybe someone who
we need more clarity, and Becky Liu is always the right person to come on and really teach us about how this all works, right? All these different sorts of debt swaps, operations, the like. Head of China macro strategy at Standard Chartered Bank. So they're throwing around the 6 trillion yuan number over 3 years, possibly. I mean, how do you think this is going to work? And how does that compare to what we've seen maybe, during the 2015 program?
So during the 2015 debt swap program, that was a very simple way of swapping out the LGFV liabilities into simply local government bonds, or LGBs. At that time, cumulatively, they've done a total of 12.2 trillion over the span of 3.5 years. This time around, we feel there will be a bit of difference. So we heard about the 2.6 trillion stories. We think both of them could be true. So in order to swap local government bonds, this time around, we believe they will be using both local resources and central resources. So we are talking about 3 different sources in our view. So first one, it's very similar to the old days. Local governments able to issue LGBs to retire some of the off-balance sheet debt. So that would be very similar to the old story. The second source would be the relaxation of the usage of the local government's project bonds. Currently, many of them are having a huge mismatch. For example, on one hand, they don't have time, they don't have money to pay for salaries. On the other hand, they have piles of idle cash sitting on their book from the bond issuance from the local government project bonds, given the restricted usage. So the relaxation of the usage can partly used to roll over other type of debt. And finally, as part of the central government financing. So about 6 trillion special bond issuance, in our view, probably half of those could be used to replace some local government debt, and the remaining half would be for other usage.
And one of the uses in this expanded definition now of what they can be used for is possibly buying some housing inventory. And we're looking at this China story almost briefing to briefing. So I'm looking at the lineup of the briefing tomorrow. You have the housing ministry, the PBOC, you have the Ministry of Finance. Do you think we'll get more details on the usage of bonds, possibly as it pertains to unused inventory in the housing market? Is that a hope that is realistic for tomorrow?
Yes, we believe so. We believe they will give more details in terms of what they're able to do and what kind of resources will be available.
Okay.
The Ministry of Finance has been relatively specific that they are now, for the first time, allowing local governments to directly use their own funds to buy commercial real estate, including the funds not only from bond issuance, but also the funding that were otherwise planned for supporting the construction of public housing. So instead of using the money to buy to construct new projects, they are now using them to buy existing projects. So the goal is basically help to digest all these inventory, increased demand for housing. And the fact that the central bank is also there, we believe they will be playing 2 roles. One is some central bank facility, probably also to support the purchase of real estate projects. And second is the better coordination between how the Ministry of Finance will be able to raise funds through bond issuance and supported by central bank policies. For example, they have been talking about the CGB buy-sell program. Yeah. So we could see a step forward that central bank is stepping up bond purchase while the Ministry of Finance is issuing more bonds.
Do you think that this is enough, though, to at least deal with the hidden debt that some of these local governments have? I think IMF puts it at, 65 trillion yuan? I mean, these numbers seem quite minuscule compared to what is the real picture.
Issue.
Yeah.
There are various type of estimations. So I think one probably median or consensus estimation is about 40 to 45 trillion CNY by the end of last year. But the thing is that this definition is different from the definition of the Chinese authorities themselves. So it's only the type of hidden debt that's recognized by the authorities would be eligible for the debt swap, not everything else. So at this stage, we don't think that they're going to have a gigantic bond issuance quota just to replace all the debt, because during this process, they are still asking the local governments to sell down some of the assets, try to raise funding from other channels aside from what could be replaced at this stage. So we do think that they would have first of all, a one-off lifting of the debt ceiling after the upcoming MPC to allow more bond issuance to replace the existing debt. And this number could be increased further in subsequent years as the asset disposal is gaining more momentum.
Okay, and that comes out to probably something that's closer to what is needed, I guess. In terms of, this is a humbling experience in China ministerial jurisdiction, which ministry can do what and such. So what are you looking out for next? So anything potentially market moving that you think we will probably hear these next, if it's not tomorrow's briefing, in the briefing after that?
For the upcoming briefings, we feel most of them will be focusing on the details about the execution. Like the overall direction or policy direction, policy framework has been announced. I would say 80–90% of those are already out. So the trajectory has been there, but the details are also important because without details, no implementation can start. So the actual implication to the economy will more likely to take 2 to 3 months after all these briefings, after the details are coming out, and when these become practical. So aside from the details that we will get a better idea of how things will be working out. The MPC is obviously one key event to look out for in terms of how much special bonds could be planned, how much additional debt ceiling would be assigned. We don't think they would adjust the official budget deficit this time around, but they could give some hint for a widening of official budget deficit in the coming 2 to 3 years. It has been quite clear that they talked about there's significant room for them to leverage up and increase deficit. And that we think it's not unreasonable to assume they can raise official budget deficit by 1% of GDP each year in the next 2 to 3 years. So if you combine the 6 trillion of special bonds, if that report was true, together with 1% of increment each year, then we're talking about 8 to 10% of GDP worth of additional fiscal support from the central government themselves.
Okay, so if I'm expecting more issuance of bonds, can I expect, what should I look for in the curve? Could it steepen more from here?
We think it's already quite steep. So if we talk about the cash bond curve, in the short term, there are still some risk on the back end of the curve. One is because the bulk of the supply are long dated. For example, the general central government bonds is only of 5 to 6 years on average in tenor, but the special bonds so far this year is close to 30 years. 28.8 years in terms of average tenor, because they're issuing in 20-year, 30-year, 50-year bonds. So the supply pressure is still on the back end. And second is more to do with the asset allocation. So we are looking at the domestic mutual funds asset allocation. Its current allocation to equity is almost a historical low of quite a bit under 30%. But its allocation in cash bonds is an all-time high, north of 65%. So that's why this is making the positioning quite vulnerable once we see a small stabilization and rebound of the A-share market. And we feel market was very impatient in the past few days. The market rallied by more than 30% in the 6 trading days after those briefings. And even after the correction, is still up by about 20% from in the last only 12 trading days. That's still a very rapid pace of rally.
The notion we're getting, to your point, that's a very good point you bring up. The notion is that investors who have waited for the rally, the capitalists have parked their money in the bond markets, and that's going to be the area to watch as a place to fund the equity rally. So everything tells me and everything tells us that yields should be higher. So why are they falling?
Well, at this moment, we feel that the monetary policy easing will also be gathering pace. For example, if we look at the 2014 experience, that was the last meeting when a September Politburo meeting was used to discuss economic issues. And at that time, equity market more than doubled after that meeting in 3 quarters since September 2014. But during the same time, monetary policy easing was quite quick, and bond yields still managed to fall. So this time around, we feel that rates still have to fall. So if we assume the PBOC would be cutting 10 bips for every 25 basis point cut by the Fed, and based on the current market pricing of the Fed expectation, we could be talking about 7-day repo going down to about 1% by mid-2025 from 1.5% now. So rates in the medium term could still come down after some initial adjustments.
Becky, I feel like every time you come on, I'm going to school and I'm learning from a professor. Becky Liu, thank you. Head of China Macro Strategy at Standard Chartered Bank.
Goodness.
I have to watch. We always have to rewatch Becky Liu's interviews again.
That's on my to-do list right after the show.
Just to take note of things. Still ahead. Why tariff? Yes, is Donald Trump's favorite word. That's what he said in our interview with the Republican presidential contender about his economic agenda. More from that interview with our editor-in-chief coming up next.
Season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
All right, we're watching the chip makers, chip equipment makers in Asia. They're really feeling the pressure today after what we heard from ASML, those shares slumping the most in 26 years after they talked about cutting that guidance for 2025, also booking only about half the orders that analysts expected. Let's get to our tech reporter, Annabelle Drewlers. She's in Sydney with more. Annabelle, this was a big miss on what analysts were expecting. What did the sell side get wrong here?
Yeah, really, really sizable. I mean, you think about where the expectations were from Wall Street, and you were looking at sales of around $5.9 billion US for the third quarter. They came in about half of that, so $2.8 billion. It just does seem like there's concerns around that sort of two-speed recovery we're seeing in the semiconductor industry. Of course, you've got that continued optimism you see around AI chips, and ASML, as a chip equipment maker, is providing the machinery that makes the most advanced semiconductors on the planet. But at the same time, there is the legacy chip space as well, and we're not really seeing that recovery just yet for chips that are used for things in automotives, for instance, consumer electronics. And this really flowed through in the latest readings here, because you're seeing some of those things there with the bookings guidance as well that was reduced going into next year. And of course, that big share price reaction off the back, the biggest drop, as you said, going all the way back to 1998. The company as well, just to note, they actually released the results rather 1 day early. The company saying that was a mistake, some sort of technical issue, but something as well that could have sort of fed into that shock that the market saw.
Yeah, Belle, let's stay on the space. So the red headline that crossed the terminal earlier on, and there've been murmurs about this anyway. The possible takeover bid for Intel from Qualcomm, and they might be to it a little bit. What's the latest here? What do we know?
Yeah, so this is, of course, possibly looking at one of the biggest ever M&A deals in history. But essentially, we had that reporting that Qualcomm back in September was looking at a possible takeover bid for Intel, its peer in the US. Now, at that time, we heard that they had also approached, Qualcomm had approached Chinese regulators, antitrust officials to sort of gauge their reaction to it, and they hadn't heard anything just yet. But what we're hearing now, the latest on this, is that Qualcomm could be considering pushing out any sort of possible takeover until after the US election. And it's not only that thinking around what's the relationship going to be like with the next administration between Washington and Beijing, but there's also concerns about the antitrust landscape as well. And so that's why we're hearing that any sort of decision around this could be pushed into early 2025 as well.
And are there reasons it might make sense for Qualcomm to wait, Belle?
Well, the other big reason really comes down to the earnings, because Intel's going to be reporting at the end of this month, and if you cast your mind back to the second quarter figures, they were very, very grim for the company. We saw a huge share price slump off the back. We saw more layoffs being pushed through, and the guidance that we're expecting for Intel this time around is we're going to see losses of around $1 billion US. So of course, if Qualcomm waits further, the price tag might end up becoming cheaper as well.
Belle, thank you, Belle, in Sydney for us there on all things chips. And we're not done with the story, the big one, of course. And we have more on the way, and we will be speaking exclusively with AMD and the Chief Tech Officer, Mark Papermaster, about their new AI products and the outlook there for the sector in the Asia-Pacific.
All right, more from our interview now with the Republican presidential nominee, Donald Trump. Well, he has told Bloomberg tariff is his favorite word, as he denied his protectionist policies could fuel inflation and spike the national debt. Trump spoke to our editor-in-chief, John Micklethwait, about his economic agenda just 3 weeks out from his election showdown with Democrat Kamala Harris.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before. And we're going to protect them when they come in, because we're not going to have somebody undercut them.
Donald Trump there with our editor-in-chief, John Micklethwait.
All right, getting close to 10:30 a.m. in Hong Kong. We're just about half an hour away from that policy address from the chief executive, John Lee. Will deliver at the Legislative Council and really this third annual address to talk about the potential, everything from support measures in the property market, maybe this potential cut to the liquor tax, which we've been talking about for the past few weeks as well. So certainly a lot on tap here in the next few minutes, Dave.
Yeah, any indications on many of the key sectors for Hong Kong, F&B, financials, the various talent schemes here in the city. Let's get a preview with our chief North Asia correspondent, Stephen Engel. In fact, Steve is just outside LegCo right now. Yeah, Steve, what are expectations ahead of this?
Yeah, I mean, it's an open book. I mean, anything could happen, really, with John Lee. I mean, a year ago, of course, they removed a lot of those restrictions on home purchases. That helped a little bit, but the property market obviously still in the dumps. There's still some issues, obviously, with the stock market, still one of the worst performers of global major indices since the end of 2020, even though we had that big rally on the back of stimulus. So stimulus from China helping this economy, but how long is it going to last? That's the big question. Obviously, the Fed cutting rates, that helps Hong Kong as well because of the dollar peg. But again, where are we going to go from here? What other stimulus could potentially, what other goodies, sweeteners, could John Lee, the chief executive of Hong Kong, provide in his annual policy address in the building behind me coming up within the half hour? It's a long address, a couple of hours. We're going to get some insight from Gary Ng. He's with Natixis, senior economist, Asia Pacific. What are you expecting? What can he do? What should he do?
Well, I do think that he will focus on two major areas. The first is on the economy because growth is really a main problem in Hong Kong right now with this declining competitiveness in many key sectors in Hong Kong. So this is why we need to see a stronger support towards the financial sector and the real estate sector. And beyond that, there are of course a lot of social problems in Hong Kong as well. For example, in the housing, subdivided flats. I do think there will be some sort of solutions given from the government in solving part of this problem. But of course, we're talking about a lot of goals here. It's really about whether the government can target the core problems so that the other problems may not be as obvious or easier to solve.
Now, you said in your notes, he'll probably be firing a lot of arrows at multiple targets, small targets, though. Is he going to hit, though?
Well, I think it's probably hard to say. And of course, the government wants to do a lot of things. For example, the transition beyond the financial sector, building Hong Kong as an event hub, etc. and etc. But still, if we actually see the government solving the core problem in the financial sector and the real estate sector, actually naturally that will bring more consumption and investment. So targeting a lot of small problems will not basically help the structural issues.
I mean, it's trickled down here, right? Financial services is the backbone, the bread and butter of Hong Kong. It's been hurt, obviously, by the lack of deal flows, exacerbated, obviously, by China's slowdown and geopolitical concern. How do you get out of that slump and get bankers to hire again and stop laying off?
Well, it is really about whether there are opportunities in Hong Kong. I do think that one of the ways the government is doing right now is to diversify beyond the China's market, which is obviously fast growing, but also tap into other sort of capital. I do think that is helpful in retaining Hong Kong competitiveness. But beyond that, I do think that Hong Kong will need to be bolder in terms of, basically getting more constructive policies. For example, an IPO Connect will be something very beneficial for Hong Kong.
What can he do to kind of put a floor on the property market? I mean, there's multiple different property markets. There's residential, obviously, it's been hit, even though the curbs have been removed. Retail has been hit badly because retail sales are down for 6 consecutive months, double-digit losses. Retailers are really suffering. Rents are coming down. And commercial, these buildings behind me, many of them have lots of vacancy, because there's just not enough demand. So what can he do to address these problems?
Well, I would say that the residential problem may be less severe than the commercial, because as long as Hong Kong is able to attract people into the city, then people will need to find a place to live. So some relaxation on the investment schemes, encouraging basically the young people in Hong Kong, building up the ladder so that allow them to actually buy a properties eventually. And more importantly, I think helping the middle class to actually reduce the living costs so that they can actually afford to buy a house. I think all these measures or the directions will be key to actually basically help the residential market. However, for the commercial side, I am a bit conservative, simply because there's a huge supply coming up, and obviously retail services is not doing that well. For offices, they also the work from home arrangement. Let's not forget, there's also a lot of employment opportunities that may have shifted away from Hong Kong towards other competitors. So all of this doesn't bode too well for the commercial side.
Right. So you talked about these investment schemes. There's the CIES. They relaunched it, called the new CIES. That is what the Capital Investment Entrance Scheme. They relaunched it in March. Basically, foreigners can bring in certain amounts of investment and they get permanent residency, but they got to keep it here. They got to invest in bonds. Can they broaden that? Is that something John Lee, could that be the big headline if he broadens that and say perhaps, this is just throwing this out here because Bloomberg Economics talked about this, Bloomberg Intelligence, in fact, said, why not broaden it to residential home purchases?
Well, I think it's possible, but I think one of the points that the government will have in mind is also the home affordability. So if it is really broadened towards that way, I do think there will be some restriction in terms of the value of the properties. It need to target the high-end one, otherwise it will affect the middle class from a more severe way, which is probably not the right policy intention as well. But I do think that this is one of the points that basically Johnny can make, and it's an easy one.
Do you think Hong Kong still has a perception problem from the pandemic and the protests? Because look at the number of flights. They've not come back. Japan has boomed. The yen has been weak. That's helped. Korea has boomed as far as tourism. Thailand has boomed. Hong Kong has not. We're not even back to what, 3/4 pre-pandemic records in 2018. What are they going to have to do other than, reduce liquor tax to bring back the nightlife economy and have pyrotechnic and drone shows out here in the harbor? They have to do something more to get more seats on airplanes coming to Hong Kong.
Well, I think the aviation problem is really about the demand and supply. So if there's enough demand, obviously airlines will be happy to actually get back to the city. But the problem we see here is that Hong Kong is actually undergoing the structural changes in terms of the consumption pattern, and we do not see a very clear roadmap of what the government wants to do to build Hong Kong into a tourism city. And for example, look at South Korea. There's a very like a sharp government initiative in promoting the culture together with tourism, drama, etc. Also look at Japan and France, etc. So I do not see that right now. Probably, hopefully, we will see something good in the policy address, but still, I think it's a problem that cannot be solved immediately.
So the Hong Kong government has this new toy across the harbor, and that's the new Hong Kong Stadium, which will be the future home of the Rugby Sevens. Also, multiple concerts by Coldplay and others. How likely is it that Hong Kong can become a concert and destination place for big events, like Singapore was able to sort of monopolize Taylor Swift when she came to the region?
Well, I do think that Singapore and Hong Kong probably target different sort of customer. I think the good advantage of Hong Kong remain right next to mainland China, which basically means that it's quite easy for Hong Kong to attract all this basically audience from mainland to the city. So I think this is something that is a bit harder to do in Singapore. So I do think that having that venue is helpful, but it still depends on all the planning that the government is thinking of, how to encourage there's not really too many red tapes and attracting, artists to be here.
Very quickly, given the fiscal situation here, does John Lee have room to give welfare handouts, cash handouts, and tax breaks?
Well, I think it's probably quite difficult. The government will probably need to focus on cutting unnecessary expense and refocus on the economy, but I do not expect too much sweetness from it.
All right, Gary Ung, thanks so much for joining us out here. A beautiful, windy, sunny day on the shores of Victoria Harbour. Back to you.
Yeah, very windy. Steve, show us your sunglasses, man. All right. Time to whip them out. Gary Ung with Stephen Engel there, of course, right outside LegCo, where we're still counting down, of course, to the annual policy address. Now, really good point that they ended on there, the sort of sweeteners that we should be expecting out of the government. The reality, though, is when you look at the monthly budget of the government, surplus and deficit, and this is a 12-month average, so it sort of corrects for monthly noise. As you can see, since 2019, the government's been running larger deficits and really putting pressure on their ability to spend, and a lot of this also has to do with the fact that land sales haven't been as robust as recent years, which is a key revenue driver for the government.
It certainly hasn't, but Bloomberg Intelligence has been crunching the numbers, thinking, if we get anything from John Lee here today, Hong Kong developers could see a buyer's rush. Yeah. Let's bring in Patrick Wong, our senior analyst. He joins us now. So we talked about land sales revenue is what, just under 3 billion Hong Kong dollars. That's only about 8% of its annual target. Are you expecting the government to roll out more stimulus measures for the property market?
Yeah, that's true. I think this is also a little bit urgent, right? When the government, the land sales revenue is only 8%, right, for now, right? So definitely we could see the government to roll out something to support the housing market. For example, I think the capital investment entrance schemes is the one thing that could bring up, because the challenge for now is that we only received something like 500 applications since we launched. And part of the reason, I think, is about they could invest the stock market, the funds, right? And also even commercial market, commercial properties, they can invest on that, but not residential. And the demand is, John, you see the housing rent is going up quite a lot this year. So basically, I would say that potentially the government may also relax on the residential. Of course, it's also a bit challenging, right? Whether they relax on like if just the mass market, they also bring up another challenge. Lots of local residents will not happy. So definitely, I think it could be potentially going to some more high-end residential properties that they will allow them to invest.
And yeah, so far, to your point, it's only rents that have picked up. Prices are continuing to fall, if not, bobbing along the floor right now. What's your outlook for prices? Can they recover this year, or is that potentially only a 2025 story?
Yes, the interest rate outlook I think is important, right? Of course, today we see what Zhang is going to announce, which may also have some support to the overall market. And then the interest rate cut also very important. We see the prime lending rate cutting like 25 basis points in September, also bring up some support. We see the recent new launches like those like Sun Hong Kai or CK Asset, they also going to be a pretty strong momentum. That could also be a potential catalyst to support the housing prices stabilizing at least in the fourth quarter. Hopefully a bit turnaround going up next year.
Yeah, what does this mean for some of these developers and the business outlook? I mean, we saw that some of them have already started selling these fire sales, basically, on some of these new homes.
Yeah, true. I think like Sun Hong Kai, for example, just mentioned like they have the Kai Tat project just launched, and past 2 weeks they sold like over 400 units. And we also have a focus idea today mentioned that the Sun Hong Kai could beat the 100 sales target by 20% or even more. Like could reach like 30 billion Hong Kong. So we see the momentum is turning back, right, in terms of the home sales. So for business-wise, I think developers, some of them may also have a more potential upside in terms of the home sales going to later this year and next year.
Patrick, thank you. Patrick Wong, our Bloomberg Intelligence senior analyst there. You can get more, by the way, on Hong Kong. Our insider's guide to the money and people shaking up the finance hub. And make no doubt, of course, the policy address will be front and center in the upcoming one, I believe, which comes out tomorrow. Yeah, Bloomberg.com/newsletters there.
All right, we got plenty more ahead. This is Bloomberg.
Right, welcome back. You're watching the China Show. Now, some of Wall Street's big banks have reported a windfall, in fact, cashing in on really a volatile quarter across these markets, the most volatile one, in fact, since the pandemic. So you have the likes of Citi, Goldman Sachs, Bank of America have all posted, equities and fixed income trading hauls that really surpass estimates. Let's bring in Matt Ingram, our Bloomberg Intelligence senior analyst, to talk us through this. I mean, Matt, it's been a good year so far.
Oh, look, it's been an absolutely unbelievable year, David. It was on the back of some weaker stuff last year, but I think David Solomon sort of summed it up. Uncertainty makes clients very active, and very active clients makes for very good trading revenue. So we've seen on the fixed income side and the equity side, things have been very strong. How does that look going forward? Well, Jamie Dimon said that things are going to remain turbulent. Like uncertain markets, turbulent markets create opportunities for banks because of the trading volumes. So we don't see that uncertainty and that turbulence going anywhere.
Okay. Can you tell us a little bit more about the risks? I mean, obviously, there's still fears out there that the U.S. could eventually get into a recession and the like. Well, what's going to be the outlook moving forward?
Yvonne, this is the funny thing. We've had fairly elevated rates now for about 12 months. Fearmongers everywhere are talking about a recession in the US, but the balance sheets for these big banks are just rock solid. They're holding up really well. At the margins, you're seeing credit cards weaker a little bit. You're seeing some corporate issues here and there. But with an expected 100 basis point cut in the US this coming 12 months, and the fact that we aren't seeing any problems so far, credit's holding up really well. This is more about a revenue issue heading into a rate down cycle. Credit looks really quite healthy, which to be frank, has surprised us.
Yeah, and Matt, what does this tell us likely about headcount and where trends are going to be the next couple of quarters here?
Sorry, did you say headcount?
Yep, headcount.
Look, costs are front and centre, they always are. The banks clearly haven't explicitly said that headcount cuts are coming, but every time each of these banks reports, the same thing is stressed. We are on top of costs. We are watching the costs. We are really concerned about maintaining that bottom line if revenues weaken. That, to me, spells headcount cuts. There's no other way around that, particularly given inflation remaining a bit sticky. So, yeah, look, to keep the lid on that cost, there has to be further headcount cuts across the sector.
Matt Ingram, great stuff. Thank you so much. Our Bloomberg Intelligence senior analyst joining out of Sydney to recap some of the U.S. bank earnings for us. Another stories that we're following this morning, U.S. listed shares of LVMH slumped after the luxury goods giant missed estimates in its latest results. Sales fell for the first time since the COVID-19 pandemic, hampered by slumping Chinese demand. Morgan Stanley says declines in third quarter organic sales for the LVMH fashion and leather goods unit came in well below expectations. Shein is said to be adding more banks to help arrange its potential listing in London. Sources say Barclays and UBS have been picked as bookrunners for the online fashion retailer's IPO. We're told the listing could happen as soon as early next year, valuing the company at around $65 billion.
Okay, let's get you more in case you missed the big interview we just did. Hear more now from our interview with the Republican presidential nominee Donald Trump. So 3 weeks, of course, before the U.S. votes. Now, Trump was talking with our editor-in-chief, John Micklethwaite, over many things, tariffs being one of his favorite words, if not his favorite word, levies on Chinese steel imposed in his first term, he thinks have proved to be, well, fairly effective. Have a look.
If you want the companies to come in, the tariff has to be a lot higher than 10%, because 10% is not enough. Guys, they're not going to do it for 10. But you make a 50% tariff, they're going to come in. Let me tell you the other thing about tariffs that's great. Our steel companies, as you know, 3-4 years ago, they were all when I was in office, I saw a man from a big steel company, and he was devastated. I knew him for a long time. And it's been a tough business. It was a great business many years ago, and I would not let U.S. steel be sold to Japanese, by the way. It's psychologically, I think it would be
That's a Nippon steel, as you know.
Yeah, I wouldn't I wouldn't let it be sold. But I would, I would stop it if it hasn't been completed by the time I'm president, because I think it sets a horrible tone. But I had a lot to do with steel. We were going to lose all our steel companies because China, as you remember, was dumping steel at levels that nobody's ever seen before. And I put a 50% tax on that and a tariff on that, all dumped steel. And it was also bad steel. It was what they call dirty steel. It wasn't good steel, which is a bad thing for structural components of buildings and planes and things like that. They were dumping crap into our country. And I put a 50% tariff. I started at 25. I raised it to 50 because the 25 didn't quite do it. I raised it to 50, and that did it. They stopped dumping steel. And I saved our steel mills by having that. We saved it. We saved our steel. Now, what was left, because we've lost so much, but there are certain companies you have to have. There are certain things you have to have. Steel, you have to have. If you go to war, you know, there's a possibility you go to war. I kept us out of war. I was the only president in 82 years that kept you out of a war, except I defeated ISIS, but I inherited that war.
Donald Trump speaking with Bloomberg's editor-in-chief, John Micklethwaite there. And there is more on this election race in today's Bloomberg Big Take, which looks at how dozens of lawsuits are playing into this campaign. Subscribers can read that story in full on the terminal and on our website, Bloomberg.com. We have more ahead. This is Bloomberg.
Welcome back. Just a quick glance across these equity markets. So, I mean, this time tomorrow, markets could be running up even further, particularly these group of names on your screens because of, well, what's on the agenda depends, of course, what they'll say. So we're looking ahead to the briefing this time tomorrow, and as you can see, property names are up 7 to 8% ahead of what I guess is expected to be a lot more details on the housing support measures here.
Yeah, if we get anything, and certainly that's the next one to watch. But the housing ministry, that's the latest, the newest sort of member here in all this when it comes to these press briefings are concerned. So there you go, China Wanka up some 12% this morning. You take a look at some of these water supply stocks. So there has been some revisions to the tax program. That's how we're seeing some of these stocks gaining this morning as well. On the back of all these micro news, we're certainly watching some big policy decisions in Southeast Asia, at least 3 that are going to be having their rate decisions. So we're talking Bank of Thailand, we're talking Bank Indonesia, BSP as well. It looks like we're having about 2 that are going to hold, Thailand and Indonesia. Philippines, though, we could see a cut today, Dave.
Yeah, most economists, and I guess the vast majority, actually expect a 25 basis point cut to 6%. There is one economist, though, and I'm not going to name the name here, but in terms of the forecast, you expect a 50 basis point cut today. So suffice to say, we will likely see a reduction there in rate expectations. Have they been able to move enough outside of the Fed conversation? And, you know, recently, of course, the conversations around the Fed is they might not be able to reduce rates as quickly as they initially thought. And how does this affect, of course, the guidance from a lot of these central banks in the region? Yeah, and I think George Sun had a good point, right? It's not just about the discussion that we're hearing from the Fed, but also this resurfacing of Trump risks right now. If he is serious about implementing these tariffs, that could be inflationary and actually could force the Fed to actually pause when it comes to these rate cuts. So what does that mean for central banks here in this region? Out of all those 3, though, Thailand has really resisted in launching this easing cycle, right? Of all the central banks.
Of all of them. And continue to defy what the government is saying. I think the finance minister just even said just before this decision, yeah, maybe it's time. The time has come right now. We'll see if they give in at all. But yes, obviously with the dollar moves that we've seen, the strength coming through on the back of some of those Trump comments also, one thing to watch for Asia FX as well. Yep. All that being said, in the next hour, of course, speaking of banks, we had the biggest bank in the Philippines, I think, by assets. Nestor Tan, the boss of the bank, joins us to talk us through his thoughts on that, plus, of course, monetary policy. This is Bloomberg.